Hey everyone, today on the Final Bar, it's Monday, March 6th. Happy Monday. We'll talk about what this market has done. Opening strong, morning session, pretty decent. Afternoon, giving back all those gains and more. Biggest weakness in small caps. The S&P 600, the Russell 2000, both down big. Small cap index, the 600 down 2.25%. Ladies and gentlemen, this is the Final Bar. Hey everyone, welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of StockCharts. The StockCharts platform was designed around three pillars: excellent tools, expert commentary, and education to empower you to make better decisions. And we hope in the course of our 30 minutes together every weekday after the close, we can pepper a little bit of each into your day and help you make sense of things, right? Our goal is to inform you about what's going on, but really to help inspire you to dig deeper by using the best practices of technical analysis. What's interesting about a day like today is, I don't feel like it's an accident that the S&P and the Dow having a really strong morning pull back in the afternoon. If you look at where they bottomed out, it was literally right at Friday's close. That's where some additional buyers came in the last 30 minutes of trading, providing a bit of a bounce to the upside. The NASDAQ not holding Friday's close, though, and going to the downside after having a pretty decent morning. So we get a bit of a mean reversion after Thursday's strength into Friday's rally. Today, sort of giving those back. We're seeing some of those what are called shooting star candles, and I'll show you an example on the S&P and other markets showing that short-term distribution. Tells you the next 1 to 3 bars are most likely weaker rather than stronger. Let's get right into the market recap, and I'll show you what I mean. Looking at the big picture, and then we'll look at some individual charts to sort of round out the illustration of what we saw today. The S&P, as I mentioned, finishing narrowly positive, but not by much. S&P closing at 40.48. That's just a touch above Friday's close. The Dow also about 0.1% above yesterday. The NASDAQ composite finished just narrowly in the negative. But look at how that compares with the S&P 600 small cap index, the S&P 400 mid cap index. Small caps down pretty big with the S&P 600 down 2.3%. Now, the VIX moving back higher, even though the major averages sort of were flat for the day after all was said and done. Volatility increasing, right, with the VIX actually pushing to the upside. Looking at other asset classes here, interest rates moving higher, which tends to be a more difficult sort of scenario for technology and sort of other growth sectors. So if you look at what happened, bonds actually opened higher, traded lower through the course of the day. The TLT down about 0.8%. This is the 30-year Treasury yield. You can see opening pretty low around 382, 383. By the end of the day, pushing above 390. 10-year yields, which we follow pretty closely, right about the same level, around 398. Dollar index, not too much change from yesterday. And commodities, a bit mixed, actually, although gold and silver, which we've talked about quite a bit, both down. The gold ETF, GLD, down 0.5%, silver down 1.2%. Crude oil actually pushing a little bit to the upside, but natural gas moving down in a pretty major way. Also a mixed bag of sorts for cryptocurrencies, but the two major ones that we track, Bitcoin and Ethereum, both trading lower, certainly in the afternoon of the U.S. equity session. You can see both of them rotating a little lower into where we're broadcasting today. Bitcoin around 22,340. Let's look at a chart of the S&P 500. We'll come back and check in on some of the other items to pay attention to. If you remember from Friday's show, we talked about the market trend model that I keep updated every Friday after the close, giving a bullish signal on the medium term and short term, still bearish on the long term, but just narrowly. So it's interesting as we set the stage for today. Thursday was sort of an open lower, move higher day. Friday really just was like jumping off a springboard and pushing to the upside. Opened at the lows, closed at the highs. It was just a steady stream moving to the upside. Today, a little more nuanced. We opened, we traded higher, but by the close, we got back below the open. And that's the little bar that you'll see here. We'll zoom into that bar here in a minute. But what I wanted to point out was just thinking about one day's movements relative to the bigger picture. Regardless of what happened today, if you think about the overall structure in the market, at least by my definition, the trend's still positive. If you define the trend as Charles Dow did over 100 years ago, it was sort of look at the highs and look at the lows, and not just every day, but take a step back from your screen and pay attention to the key turning points, what we call the key pivot points. Are the low prices getting higher? Are the high prices getting higher? And I see a series of these that I think sort of illustrate that very well. And it's not just this chart, by the way, that shows this. If we look at other charts like semiconductors, these are very poorly drawn trend lines. Sorry about that. But if you look, you can see what I mean, right? Higher lows, higher highs, and an uptrend is defined by that general progression going higher. So what tells you this trend is over or likely over? It's we break the pattern, right? And there are a couple ways we could break the pattern. We could put in a clear lower high, which tells you the attempts to push back to the previous high failed. And there was an exhaustion of buyers is what I would generally sort of characterize that as, right? And there wasn't enough momentum to push us to a new swing high this time. The other option would be we break down through support. You draw a trend line from some of the previous lows. We failed to hold those levels, and that's a concern. I was concerned about that certainly last week as we traded lower in the beginning of last week, Monday and Tuesday. We traded down to a trend line. We broke a trend line using the intraday highs and lows, or the intraday lows, that is, but we did not break one using the closing prices, which is that blue dotted line that you see on the bottom. Traded right down to it, also traded down to the 200-day moving average, and then bounced right above there. That bar configuration is what's called a bullish engulfing pattern, or what's called a bullish outside day, which is basically a short-term reversal signal to the upside. That leads us to where we're at today. Here's the issue. If I turn this into a candle chart and zoom in a little bit, you can see this is today's bar right here. And you can see all the lines and the shading are still here from my previous chart, but this is the candle that I want you to focus on. Here's the rally off of the low, off of the 200-day moving average on Thursday session, where we opened lower and closed higher. It's called the bullish engulfing pattern. Friday's strength going into the weekend. Today, we opened here, we trade higher, we close lower. A lot of charts are featuring that particular configuration today because of sort of the inverted V shape to today's trading. What that creates is what's called a shooting star pattern, which is a limited lower candle, high or a lower wick, a long upper shadow or long upper wick, and essentially that is a short-term reversal signal suggesting the next 1 to 3 bars are most likely lower. What would eliminate that and what would invalidate that bearish reversal pattern would be getting above the high of today's trading. So we get above 40.80 in the next day or two, and that would negate that and say, nope, false negative, and we're most likely going higher. So interesting that you're seeing this sort of short-term distribution as we sort of enter back up toward the upper end of the shaded area, back up to the congestion range we saw the first couple of weeks in February. It tells me that, at least in the short term, we're not sort of out of the woods yet. We've mentioned that, right? As we're in the shaded area, it's more neutral. We get above 4,100, we follow through there. That's more encouraging. Day like today tells me we're not quite there yet, unfortunately. Now let's look at some other details of what we could find today, looking at some of the different patterns. Briefly on sectors, and then I'll show you the RRG and showing you the rotation of the sectors. But today, 2 sectors tied for the best performer, both up about 0.5%. So not a big up day, but certainly at the top of the list, technology and utilities. And what's interesting about that is those are 2 sectors that I would loosely define as fairly offensive, or not offensive, but offensive, and fairly defensive, right? You've got traditional offense and traditional defense both up. After that, it's consumer staples, which is a very defensive sector. So, at the top, you also have sort of this mixed bag. On the bottom, we have materials, which was down in a pretty big way, down 1.6%, consumer discretionary, and then real estate rounding out the bottom 3 of trading today. So I'm not a fan of drawing too many long-term conclusions from short-term data. So I don't know about drawing big picture conclusions based on one day's trading, but the weakness in materials certainly has me thinking of a lot of the charts that we've certainly been featuring recently. Steel names in particular, with these nice runs higher, making a new 52-week high on Friday. STLD Steel Dynamics, which we talked about, I think on Thursday and or Friday's show, down 3% today. I haven't looked at some of these yet, but Nucor, down a little, right, down 1.6%. So, are these the end of the world breakdowns? Certainly not. But you're seeing a pullback as it's testing resistance, right? So as we were attempting to make a new high, we're stalling out from Friday's close and rotating lower a little bit. It could be just a pause that refreshes before the next leg higher, but this is why we wait for a breakout above a key level to sort of confirm Yeah, this is an upswing. Now, what happens if something like Nucor would move lower? What's great about charts like steel companies, which have had pretty good runs and have had this pattern of higher highs and higher lows, I would argue you have a really straightforward stop loss that's naturally built in. When I would look at this chart, again, all else being equal and not, recommending a particular approach here, but just sort of thinking about the general way you can use the chart is look back to where we bottomed out before. So the last swing low was sort of right in this range, this 160, 165 range. That's where we pulled back in early February. We retested that in late February and then bounced higher. We're now retesting the highs. If we would trade lower, I'm looking right at that 160, 165 range. Also, the 50-day moving average is right about there. So you have a number of things sort of aiming there. So you could see a pullback to that point. The chart, I would argue, still looks fairly constructive as a long-term chart, but it's just telling you there's short-term weakness. We start to fail to hold those levels. That's where we have what's called the change of character, in my opinion, which is something's now different, right? We have a new input, something's changing. If you draw a trend line off the lows, that would most likely break that trend line support. We break below that level, and I think you have maybe cause for bigger concerns, and certainly should inspire you to sort of rethink your positioning on it. But at this point, this is one down day, still within a fairly constructive chart structure, I would argue. Now, I mentioned the relative rotation graph. It's super fun, I tell you, to have Julius de Kempener part of the StockCharts team. He is a fantastic person with a lot of really good ideas about visualizations. And it's been such a pleasure working with him for years on the RRG and this methodology. When we're using the weekly RRG, so this is looking at a little long-term view of the 11 S&P sectors, look at what is starting to work. And what I mean is it's in the leading quadrant and heading northeast, or at the very least an easterly direction, meaning it's improving on a relative basis. Communication services, technology are the two that I think I would describe as showing that long-term strength. Real estate, not bad, but it's actually heading sort of southeast, which means the momentum is stalling out. These are the sectors showing improving relative strength and improving momentum, which is because they're in the leading quadrant and heading up and to the right. Consumer discretionary, not too far behind in the improving quadrant, the only one there. What's rotating into the lagging quadrant? Some really defensive areas of the market like utilities, consumer staples, and healthcare. Some of the cyclical leadership like materials and industrials actually rotating into the weakening quadrant. So you see this general rotation on the bigger picture structure, really thinking, I guess I would sort of loosely think of it as year to date. You're seeing a rotation away from some of those value and defensive oriented parts of the market and into the growth. Here's the kicker, though. When you look at the daily RG, you look at the short-term rotation, this is where you can see a little nuance. For example, industrials, which had been very, very strong, actually heading south a little bit. Staples, which had started to improve, heading south. Technology actually improving, and that's an area of the market I would certainly look for opportunities. Semiconductors, certainly a group we've highlighted in there, but other pockets of tech, even if you don't buy into the growth story, certainly showing some signs of strength. Let's take a quick commercial break. We'll be back answering your questions from the Final Bar mailbag. We'll see you in a minute. Hey, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's a pleasure to put this show on for you. We have a really good team at StockCharts TV doing so with me every day. We just did a studio test earlier this morning, and we're excited to do the next episode of The Pitch, actually live from our studio tomorrow. We'll get to that here in a minute. Just want to give you a couple of announcements before we continue on with our mailbag. First off, we welcome your questions. The mailbag that we're about to share with you is featuring questions from people like you over the last couple of days. So keep the great questions coming. Our email is thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV, and we're on YouTube. Put a comment below the video you're watching on our StockCharts YouTube channel. We'll hope to answer one of your questions live on the air. Friday show, end of this week. Upcoming schedule, just so you know, we have 3 really good guests for you this week. Mike Zaccardi, who's an investment writer, a StockCharts.com contributor, and focuses on technical ideas for financial advisors. He'll be coming through tomorrow on March 7th. On Wednesday, the 8th, Aaron Swenlin of Decision Point. On Thursday, the 9th, Larry Tentarelli, editor of Blue Chip Daily Report. Also, as I mentioned, we're going to be doing live from the studio tomorrow. On Wednesday, March 8th, we'll be doing our latest episode of The Pitch. This is featuring 3 fantastic guest experts, Mary Ellen McGonigal, Mish Schneider, Aaron Swenlin. I've had all 3 of them on my show in the last week. Aaron will actually be on there on Wednesday, and all of them will be a part of this fantastic exercise, each of them pitching 5 stock and ETF ideas. Go to stockcharts.com/thepitch for more info on that upcoming event. Let us continue on our show today with the Final Bar mailbag. Let's get to question number 1. And I love this question so much. Dave, if sectors were lottery tickets, which lottery ticket do you wish you would have bought more of with your kids' college funds? So what's really funny about your question, and I appreciate you sending the candle glance along with you, which I'm showing on the screen here. My kids are actually a little earlier on maybe than yours. You phrased that question looking retrospectively. I'm not to college yet. My daughter's in high school. I have a son who's in elementary school. So I'm still playing the long game, as it were, of planning ahead for it. So if the question is where would I look for opportunities, to be honest with you, I think two things when you're looking down the road, you have a pretty long runway to something like retirement, kids' college, weddings, all those sorts of things. If they're further down the road, is the best thing you can do is get in the market and stay there, right? And that's sort of a well-trodden, well-known path of financial insight. I think the best benefit you have is start early and start putting money away. So I'd be happy putting it in the S&P and the NASDAQ and just sort of letting it run. So I actually do have retirement or college accounts for my kids, for my nephews, and they're all in that sort of really basic index type of bet. So I don't have to think about it. Things that I would have to think a little more actively or would want to, probably I'd put it in something like technology. I'd put it in industrials, and I'd probably put in a mix of the two because I think they both provide some good long-term growth opportunities. And particularly with technology, what's interesting is when you're thinking down the road a bit, it's less about the opportunities right now and more about the long-term potential. And what comes to mind in my conversation with John Markman, who wrote a fantastic book called Fast Forward Investing, where he talks about longer-term themes, things like AI and automation and nanotechnology and electric vehicles and all of those sorts of things, right? Those are big picture themes. So I would be placing bets where I think those opportunities are most likely going to be embraced and thrive and grow. And those are the types of places I would probably expect that to happen. Probably would put a decent amount outside the US as well, because that is one of those, that currency conversion is one of those brutal things that can hit you or maybe not. And I think diversifying away from the US at some point in a longer term account certainly makes sense as well. So that's how I would answer that question. I'm curious how those of you watching, if you have kids that are actually grown, what you would have think of looking back. But that's how I would answer that for myself. Next question. How can I sort and scan the population of ETF tickers on StockCharts to target a sector, industry, or cap size? It's a really interesting question, really thoughtful. And so I will tell you, unfortunately, it's a little limited at the moment because we have good data on ETFs in terms of their price structure and in terms of the basic fundamental data. But in terms of all the specifics, in terms of ETF holdings and other things, are not something that we have loaded on the StockCharts platform yet. It is in the works. And actually, Julius DeKempener, who I quoted earlier in the show today, is actually helping our data team really focus on that and figure out how to do it. So what are the opportunities you could do? So to be honest with you, the way that I have found ETFs a lot of times is doing a keyword search. So if you type something like semiconductor, or if you type something, I don't know, home builder or any of those sorts of things, include the keyword ETF in there, you're going to get the most liquid ETFs probably on that front page of the listing. You have to mess with it a little bit. So something like housing or home builder or construction, or all the keywords are sort of different. But that's the way I've actually been able to find most of the ETFs I ever need on here. And what I would do next from there is, what you have to remember, there are more ETFs now than ever before. I think that's right. There are thousands of ETFs, and there aren't less of them. There are more and more of them, and more specific, more narrowly focused ones. So I tend, if I'm just trying to get a read on a space, I'll stick to the major providers like iShares and S&P and others that I know. After there, you get into things like Van Eck and others, which are less and less liquid, and names and brands that I've not heard of, I don't tend to pay as much attention to. If you bring them up, you can get some basic data on assets and such like that. But overall, I think that's what I would do. So what I would focus on is just a keyword search. And honestly, I use other websites like ETF.com regularly to try to get more detail about holdings data and similar ETFs. And at some point, I'll be able to tell you, and I will be very excited when I do, that we have more ETF data. Tell you what, if that is something of interest to you, do me a favor, write into our support desk and tell them you would love to see more ETF structural data on our platform. That's going to help me to get it up in the priority queue, and I'd appreciate it very much. Next question. Someone sent me a chart, and when I saved it, their annotations went away. What's going on, and how can I fix it? So this was actually a chart that I featured on the show last week. This is one that Mary Ellen McGonigal sent me over email. And what we ask all of our guests to do is what I would suggest you do as well. If you're looking at sharp charts, click on the permalink button just below your chart. send this link. So you can either copy and paste or just click on copy link, say, put it in an email or in a chat or wherever, and it'll actually send a live link to the live chart. And it'll look just like this. You'll actually see the annotations. But here's what happens. What I usually do is click on save as and add it to one of my chart lists. If you do that, it actually removes all the annotations. That's actually by design from a long time ago when they were setting this up originally. We're actually going to be changing this here at some point when we release our new version of Sharp Charts. But for now, here's the trick that I learned from Grayson Rose and others. When you receive a chart and it has annotations and you say, wow, I love the chart, but I really love these notes that Mary Ellen thoughtfully put on here. Here's what you do. You click on annotate and then go to the little thing that looks like an arrow going down into a paper tray. That, even though it looks the same as the previous trick that I showed you, this actually will save all the annotations. So if you say, save, test, my kids are awesome. This is just in case my kids ever watch the show. And I say, yep, that's the list. So there's my updated chart on my chart list with all the annotations. So word of wisdom, if you're sending a chart, click on permalink. Don't send an image, although you can if you want, but also include the permalink, which gets to a live link to the chart, the live version of the chart. If you receive one with annotations, click on the annotate button, then click on the little arrow, the down arrow into the tray. That's the save icon. That will save all the annotations. It'll eliminate the problem that you mentioned that you have. Next question, Dave, can you explain the stochastics indicator? I can't make sense of it. And you actually had a much wordier and deeper discussion of your inability to understand stochastics. I simplified it to, I can't make sense of it. And I hope I can do so. So I will explain briefly what stochastics mean. And not a lot of my guests have referred to this, but Katie Stockton from Fair Lead Strategies comes to mind. She's always used stochastics much more than I have, and we've often talked about that indicator. So stochastics are in a similar bucket of indicators to like RSI and the Williams percent R, the commodity channel index, in that it's an oscillator. It has a clear definition. So stochastics, by definition, can only go between 0 and 100. So it is bound by a particular value, same as RSI and other indicators that I just mentioned. Other techniques like MACD and others that are based on moving average values or percentages can actually, the framework can change. So you can have incredibly newly high and low values given the strength or weakness in the underlying market. But RSI and stochastics are actually locked into a particular range. Here's what stochastics is actually doing. What it does is says over a particular look back period, it's defaulting to a 14-day period. That's the first number where it says %K 14. What it's basically saying is if I look at where we're at right now, when I bring up the chart and I look at the last 14 trading days, where are we at right now versus the highest high and the lowest low? So take the last 14 days, the entire range we've been in. What's the high point of the last 14 days? What's the low point? And where are we at right now? So if the stochastics was at 50, that would say we are currently literally 50-50. We are halfway up the range of the last 3 weeks, essentially. If it's at 88, which is what the indicator's at now, it says over the last 4 days, we're at the 88th percent above or of the way up the range of the last 14 days. So it's literally where we're at relative to where we've been. Now, the reason why that's helpful is when a market runs to the upside, you often see the stochastics become overbought. And with stochastics, it's convention to use like 75 or 80 as the overbought region, 20 or 25 as the oversold region. I'm using 20 and 80 on my charts here, which is what we default to. So when it gets up there, it basically means we're at the upper end of the range of what we've been for the last X number of days. We're probably overextended, similar to being overbought and oversold. Now, what's interesting about stochastics is you smooth that out a little more with another line, a 3-day average called the %D line, and you're looking for a crossover technique. So it's kind of like if you took RSI and you took MACD or PPO and you smushed them together into one indicator, it would kind of be stochastics. Now, that's not exactly what it's doing, so don't think that, but in terms of the interpretation, it has the characteristics of overbought and oversold indicators, but also more of a trend-following device, so it suggests when we're overbought and oversold as well. Now, there's a little more detail in the calculations. This is called the slowed stochastics, which means we smooth out each of those data points in both cases just to make it a little easier to analyze, which is a commonly used technique. If what I just said does not make sense, or if you want to learn specifics about the signals embedded in the stochastics indicator, click on the magnifying glass, type stochastics, and it'll have some chart school articles and blog posts that include that indicator, including exactly how to interpret it. Last question. How can I change my relative performance chart to show percentages instead of values. And this was a chart that you sent to me. Thanks so much for including it. You were talking about this point here. Now, I often use the relative strength where I'm looking at one thing versus another, and I use the same ratio that you are. Ticker 1, the colon, ticker 2 means the first thing relative to the second line. It's doing a ratio. Now, you are actually calculating the values of that ratio, which is fine. The values don't matter a ton. Mine uses percentages, and the difference is down at the bottom. You were using an indicator called price, which means just show me this data series. If you switch it to price-performance, it's going to show the difference, show that ratio in percentage terms, and show you how that ratio has evolved over time. There's your easy fix, and your chart looks as it should. Great mailbag, you guys, and thank you so much for the thoughtful questions. We need to wrap the show and go to the 3 and 3. Let's hit on 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1 in our market recap. We talked about the distribution that happened in the afternoon of today's trading. After Thursday's rally, after Friday's rally, today in the morning felt like it was just more of the same, right? Just pushing onward and ever upward, as I like to say. What happened, though, is we actually rotated lower. And if you look at the performance of most things during the day today is sort of an inverted V, upwards in the first half of the day, downwards in the second half. What that does for candle charts is it creates what's called a shooting star candle, which is in an uptrend. You open at a certain point, you trade higher, but then you close back at the lows of the day. Look at it, think of it like a shooting star coming down. And as you can probably assume by the visual and by the fact that it's called a shooting star candle, it means we're probably going down. So what that tells you is most likely the next 1 to 3 bars are going to be lower. The way that it would be negated on the S&P or a technology sector or any of these other charts that are featuring that pattern is you get above today's high, which for the XOK just below a 143. We get to 143 in the next day, that would eliminate that and say, nope, that was a false negative and the trend is still positive. But I'm concerned on how many of those that I'm seeing in the market today. Chart number 2 is looking at the utility sector. As I mentioned, interesting day today in that when all was said and done, what changed? Technology and utilities, fairly offensive sector and fairly defensive sector were at the top of the list. To me, days like this and movements like we saw just reinforce the fact that we are in an uncertain market in uncertain times. It's not clear cut yet, as much as many might imply that market analysis is always clear cut. I am here to tell you with some truth serum, it's just not the case. And as much as we imply confidence, sometimes it's just unclear and you have to wait to gather more evidence. I would argue that's where we're at right now. I will tell you based on the evidence that I'm seeing, the improvement in a sector like utilities, I would not bucket as a positive development. I'm looking at the XLU right here, and I'm looking at the last two years. If you look at the very bottom, this is in the indicator called PPO. Look at what has happened every time in the last 2 years when the PPO has been below zero and has given a buy signal, meaning it breaks above the signal line in red. You can see that that coincides with pretty much every one of the major turning points in the utility sector in the last 2 years. We are not quite there, but really, really, really close. And the last couple ones that we've gotten have basically rotated utilities higher. These have been more weaker times for the broader risk asset space because investors are getting in the more defensive sort of security blanket of the utilities sector. It's more of a defensive play, and you really own utilities when you want to not own other things that are more on offense. So that's another area of concern if we get that buy signal from the PPO. Finally, as I mentioned in the recap, although the major indexes sort of held up, well, the NASDAQ was just narrowly below zero. The S&P and the Dow finished just barely in the black. You can see that the Russell 2000 ETF and other small cap indexes were actually down. The S&P 600 was down over 2%. The Russell 2000, a little broader small cap universe, was down about 1.5%. Here we're looking at the last year plus a month or two, and I just wanted to highlight some of these key areas. The level we're bouncing around right now is a congestion area where we've tested it many, many times. Look at how this was support in the first quarter of 2022. Look how it became resistance in later in 2022, and now in early 2023, it's becoming support yet again. We're right at this same congestion area. We're right at an ascending 50-day moving average. So when I talk about the market potentially reversing, those are the levels that I would need to see us break. We start breaking below the 50-day, start breaking below that support zone. That is something that would concern me about potential further downside. Folks, thanks so much for joining us every weekday after the close for the final bar. I'm Dave Keller here at StockCharts.com. We'll see you tomorrow. guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.